Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And so in this situation, I have a chart here of the ISE Global Wind Energy Index Fund, and on that fund, down there along that $8 range on the downside, is where all those key lows were coming in. And subsequently, you can see that acted like a significant support level. So when we are in the process of selling puts, you at that moment want to make sure you have something in your favor to actually manage that. The question online here is, doesn't that expose you to unlimited loss? When you sell options, and you're an option seller, you do have the risk of actually owning the underlying. So think of it this way. If you sold puts on, let's say, the Global Wind Energy Index Fund down along those lows, if the position went down there and you were exercised, you actually had to own and physically buy those the units of the exchange traded fund at the strike price. So let's say if you sold $9 puts, you actually had to own that exchange traded fund at $9. To say unlimited loss, understand that you are taking the same risk of being an option seller as that of somebody who actually owns the exchange traded fund. Think of it this way: if you owned, let's say, 1,000 shares of this Global Wind Energy Index Fund, and then you actually sold 10 puts down below, you would have lost the same amount of money less the premium if you as you would have if you were long 1,000 shares or if you sold those puts. Now, the response there is, so naked positions are not allowed. You can be naked, but understand that's margin, right? And therefore, you have to use margin. You have to have a sound risk management methodology in place in order to know how to manage your way through it. I mean, if you margined your investment account and went through another bear market, trust me that you have the risk of blowing up your account no different than having sold 3 times leveraged over puts and being naked on those puts. Ultimately, whenever you use leverage, understand leverage is the risk, not the actual option position. And that's what a lot of people mistaken. A lot of people immediately associate naked calls and naked puts with risk, but the risk is actually only in how significantly you leverage yourself. If it all fits within your risk criteria, then there's no problems with doing anything like that. But to sell puts, you don't need to own the security. You need to, if you sell the puts on it, you have the obligation to own the security. So recognize that that's a slight difference there when you're just selling a put option. Understand, if you are prepared to physically own, that's when it's deemed cash covered put. Is where if you were exercised on the put down there at that strike price and you were willing to own it and then you did own it, well then you would just use it as a method of entering your ETF. So there's nothing risky about that. You just use the put as a way of actually entering. This is some of the great stuff that we teach at Option Source, and we have these great little educational webinars that we do, that we educate all our members on some of these different strategies and stuff like that that you can actually utilize. So it's always neat to see how to build some of these different strategies along the way. But in this situation, I just have an example. Let's say you sold the $9 puts. Well, what you're basically saying is if that dropped down there, I'm willing to buy it down there anyway. If it never gets down there, then I got to keep the income for having sold those puts. Now, The next thing that I want to talk about is the idea of a credit spread, or what is known as a bull-put spread. And essentially, just like it was addressed earlier in one of the questions, is that not naked and therefore unlimited risk? Well, most traders that don't like the idea of unlimited risk tend to use bull-put spreads as an option strategy, because what happens is that if you sell short a put option down over here, because you want to remove the infinite downside risk to zero, you buy a put option at a much cheaper price at a much lower strike, and therefore what you've done is you've collected an income, you've given a portion of that income to buy that lower put, but what you've done is created a way for you to make an income but have a quantifiable loss if you're wrong. And what I would say is these bull-put spreads are a fabulous tool for people that are using leverage. If you're just selling puts for income on a non-leveraged basis and you're just doing it consistently and you're willing to own the security if it goes down there, there's nothing wrong with just being a cash covered or a naked put seller. But if you're, let's say, have a $10,000 account and you're selling $30,000, $40,000, $50,000 worth of stock exposure, put options, well, buying a hedge for that by making it a bull-put spread is a mechanism of kind of preventing your account from actually ever being blown up. So that's just a technique that one can use. I just have a few people that are saying that there's no sound. Can anyone online just let us know that the audio is still coming through, and so we can continue?
Oh, I hear you loud and clear on my end. It looks like there might be
I've got like
issue.
4 messages from people saying that they're not hearing. Oh, there's
yeah,
some people that are making.
Yeah, it looks like a few people might have connectivity issues, but I hear you just fine.
I'll let you respond if that's okay.
Okay, sure thing.
To address any of the questions, I'll just carry on with the presentation.
Yep, sounds good.
All right. So nonetheless, one would consider the bull-put spread as a way, and so really credit spreads in general are really there for smaller investors that need to quantify their worst-case scenarios. Usually when you're talking with our higher net worth options traders that are trading multiple millions of dollars, well, taking on a certain amount of risk for selling some options is not a problem for them. But if somebody has a $10,000 account, it makes it a bigger problem, right? And so that's why you'll see that credit spreads tend to be things that favor individuals with smaller account sizes. And again, the risk that you have on a bull-put spread, the risk is limited to the spread between the two. So if you did a $1 spread between the two and you collected 10 or 15 or 20 cents for doing it, well, then in the worst case scenario, you might lose 80 cents if you're really wrong. And so that's just something that one has to be aware of. The next thing I wanted to talk about is the idea of selling calls. And yes, I'm talking about naked calls, but you could also talk about covered calls as well. When you're doing in this situation, let's say with natural gas, it looked relatively bearish and looked like it's kind of rolling over. Under those circumstances, if you owned the exchange-traded fund, one could consider covered call writing at the overhead resistance levels, so you can at least generate some income while owning the exchange-traded fund. The alternative also is to do a naked call, again, for more sophisticated investors that have a very effective risk management tools in place for managing that risk and have a trading methodology from which they actually do it. They could sell, when they know something is in a downtrend and they sell the naked calls up above, it allows them to profit from the downtrend as those call options continuously expire. And so you just want to observe where some of these overhead resistance levels are and subsequently sell your options above those previous highs and lows. Now, alternatively, and I was just going to point it out, is that again, if you're a smaller investor and you A, don't get approved for doing naked calls and puts, and B, you don't have the risk management mechanisms in place to do so, one could consider doing bear call credit spreads. And using the same technical analysis approaches that we talked about. In this situation, if you saw that that let's say that natural gas index fund was rolling over from these prices, one could sell the calls up here, but then you turn around and go to a higher strike price and buy the call options for a much cheaper price. So let's just say you sell the call options and receive $2 in cash flow. Then you turn around and buy a call option for 30 cents or 40 cents on the upside strike, just as an insurance policy that if this position goes against you, your risk is not limited is limited to only the spread between those two strike prices. And so that's a mechanism that a lot of smaller retail investors tend to utilize in exercising these strategies. So that's something that we actively do and teach along the way. I wanted to just give some more information on the ISE's resources for doing this, and then I'll answer questions on technical analysis. I know many of you have some questions about different indicators and different things like that. I'll be happy to address some of them over the next 5 minutes. But please take the time to visit the ISE's resources. They have a list of all their ETFs and indexes. You can actually sign up for ETF trade alerts that use technical analysis. It's right on their website. You can download those ISE podcasts that are done regularly. I do some podcasts for their for the index forecasting and so on. You can see some of my analysis on the sites there, and you can listen to the archive of all of these webinars. And so there's lots of great resources and tools on there as well. Also at optionsource.net, where I'm from, I'm the Chief Derivative Market Strategist there, we register and do these 1-hour webinars on a week in, week out basis. And on there, we give trades, and we actually tell you what trade we're doing and why we're doing it. We do it completely free because what we wanted people to do is to learn, and you can learn by actually seeing why we make the decision and what kind of an option strategy one can actually use to do that. So please take the time to visit both the ISE website as well. Please take the time to visit our optionsource.net website as well. We have lots of great forecasting videos. We get some great trades out there. You can learn more about what we do and how we do it. With that said, there's a question online from Garth just asking, is there a demo platform that you can download to practice options? There's a whole array of brokerages out there that offer that, because we're trying to stay broker neutral here. I'm not going to name any names, but trust me, if you just Google search paper trading or demo trading options, there's going to be a whole array of them that will pop up for you, and you can register for them along the way. There was also a question earlier about what technical analysis chart studies do I prefer, Bollinger Bands or Williams R or volume and so on. And one thing that we at Option Source and Learn to Trade Global, we've created what we call our master's program. And the one component of the master's program that we actually really like to get across is that most technical analysis indicators are really the same in some form or another. Really what it is you have to find technical analysis indicators which give you the confidence to be able to execute buy and sell signals. Understand that one technical analysis techniques that works for one person may not work for another because of just the confidence to actually trade it or understanding a method of trading it. The one thing I'll tell you is that there's really no right or wrong technical analysis technique if you're making money using it. But I'll tell you this much: when you use a technical analysis approach such as Bollinger Bands or Williams R or MACD or RSI or something like that, one has to take the time to actually learn how to make smart and consistent decisions with it. Understand what makes traders is the ability to be disciplined and to follow a consistent methodology time in and time out, following those rules for actually trading. And I encourage all of you to take more and more time to learn about that. Again, even though this was completely focused on technical analysis, recognize that fundamental analysis is fundamentally important to them to investing, because one has to understand the companies that they're actually buying or selling. But whether or not you actually make good decisions on buying and selling that fundamentally good stock is really a technical process. And you'll see that anyone that's really making consistent money will usually technically trade fundamentally good things. And you want to learn more and more about how to do that. And using the ISE Exchange Traded Funds is a fabulous tool for participating in the markets and finding all sorts of different great ways of actually working along and making money during the process of trading. Nonetheless, if there's no other questions, we'll start wrapping things up, but I'll open the floor up. And if there's one or two more additional questions, I don't mind answering them. But otherwise, just thank you very much, everyone, for joining me today. Thank you very much, Katrina, for having me on today. And if there's no other questions, we'll just wrap it up here.
Great. All right. Thanks again to Patrick. Thanks for sharing your insights today. Thanks to everyone for joining us this afternoon. We had a really great turnout. If you want to learn more about the ETFs that we discussed today, please make sure to visit ise.com/ETF. You'll find more product info, articles, and a link to sign up for the free trade alerts that Patrick mentioned. You'll learn how to best trade a lot of these products, so it's really helpful. A lot of these resources are great for investors who are new to the products, and they're valuable. They're free. We offer them to our webinar attendees, so please make sure to take advantage. If you have any questions or comments, feel free to send us an email at webinars@ise.com. Thanks again, and we hope to see you back next week. Thanks.
Thank you.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.